question on our minds as investors and traders in the stock market is this: why is the stock market still going up while the economy is doing worse? In this video, I'll be explaining and sharing my analysis with you, and also at the end of the video, I'll be sharing with you a chart which depicts why the stock market is still going up even while the economy is doing worse. So if you want to learn all of that, make sure you stick till the end of the video. So on the screen right now is the price chart for the S&P 500. If you take a look at the price chart over here, this is the candlestick on March 23rd. And from March 23rd and onwards, you will see that prices have been steadily increasing over the past couple of weeks. And if we take a look at the most recent price, so the most recent price was on Monday, right? So I'm filming this video on Tuesday. So the most recent price on the price chart right now for me is on Monday. And if you take a look at prices on Monday, you have noticed that prices have actually gapped up, right? So if we take a look at the past month and a half or so, you have noticed that prices have actually increased by quite a fair bit over the past couple of weeks. So against this backdrop of the rise in price of the S&P 500 or the US stock market as a whole, the US economy has actually been getting worse and worse news. Let's take a look at some examples of the news that the US economy has been getting in the past couple of weeks. This article by CNBC mentions that the US economy might be facing an unemployment rate of 23%, right? So 23% is such a high number. That would be about 1 in 5 Americans being unemployed. And the article further mentions that jobless claims over the past 5 weeks have totaled more than 26 million, far worse than anything the US has seen. This paints a really bleak picture for the US economy right now. So this article by MarketWatch quoted the chairman of the Fed or the chairman of the US Central Bank, Jerome Powell, mentioning that the unemployment rate might peak in a range of 20 to 25%. So at 20% unemployment rate, 1 in 5 Americans will be unemployed. And at 25% unemployment rate, 1 in every 4 Americans are unemployed. So that is really bleak news for the economy. While there are different economic indicators out there, the unemployment rate provides a good estimate of how the economy is doing. And based on the unemployment rates that we have seen in the article so far, this shows us that the US economy is not doing very well. And yet we have seen on our price charts that the US stock market or the S&P 500 has been steadily rising in the past couple of weeks. So why is this so? So the important distinction that we have to make right here is that the real economy is not the same as the financial economy. So what do I mean by real economy? And what do I mean by financial economy? The definition of the real economy is the real economy concerns the production, purchase, and flow of goods and services like oil, bread, and labor within an economy. And it is contrasted with the financial economy, which concerns the aspects of the economy that deal purely in transactions of fiat money and other financial assets, which represents ownership or claims to ownership of real sector goods and services. So that is the difference between the real economy and the financial economy, and that the real economy is not the same as the financial economy. So now that we know the difference between the real economy and the financial economy, let's take a quick quiz to test our understanding of our knowledge. So the first article mentions that the virus pushes German economy into recession, and Germany's economy shrank by 2.2% in the first 3 months of the year as the pandemic pushed it into a recession. So is this article talking about the real economy or the financial economy? So this article is talking about the real economy. So let's take a look at another example. This article mentions that the US GDP shrank 4.8% in the first quarter amid biggest contraction since the financial crisis. And economists expect the Q1 reading to decline even more when the final revisions are issued. So is this article talking about the real economy or the financial economy? So this article is talking about the real economy. So right now, you would have probably noticed certain words and phrases which give us an indication that the article is talking about the real economy. So what are those phrases? One such phrase that we want to look out for is GDP. So if we take a look at an article and the article mentions GDP, this typically means that the article is mentioning about the real economy. Okay, so let's take a look at another example. So this article, also by CNBC, mentions that the Dow futures jumped more than 200 points, rebounding from last week's losses. So is this article mentioning about the real economy or the financial economy? This article is mentioning about the financial economy. Okay, so one last article. So this article is an article by MarketWatch. And the article mentions that the Dow, S&P 500 fall, but breadth reading suggests stock market gains. So is this article talking about the real economy or the financial economy? This article is mentioning about the financial economy. So similar to the first two examples, there are certain phrases and certain words that we can look out for to give us an indication whether the article is mentioning about the financial economy. And these words are words such as the Dow, the S&P 500, and the stock market. So if you are looking at an article and you notice that the article is talking about the Dow, S&P 500, or the stock market, this typically means that the article is mentioning about the financial economy. Alright, so now that you are kind of an expert in telling the difference between the real economy and the financial economy, the next question you might probably have is this. So Linus, now that we know the difference between the real economy and the financial economy, and that we know that they are separate entities, are you saying that the real economy and the financial economy are totally unrelated? So the answer is the real economy and the financial economy are not totally unrelated. In fact, there are links between the two and they are governed by a relationship. So let's take a look at the links and the relationship that governs the real economy and the financial economy. This chart illustrates the relationship between the real economy and the financial economy. So if you take a look at this chart right here, the red curve is the market cycle or the financial economy, and the green curve is the economic cycle or the real economy. So what is the relationship between the real economy and the financial economy as illustrated by this chart here? The relationship is this. The financial economy leads the real economy by 3 to 6 months, right? So the financial economy is a leading indicator for the real economy. So if we take a look at the charts here, if we compare the peaks of the two curves, the peak of the red curve for the financial economy is here, and the peak for the green curve or the real economy is here. You have noticed that the financial economy reaches its peak before the real economy. So the financial economy reaches its peak here and the real economy reaches its peak here. The difference between the two peaks here is typically 3 to 6 months, and that is why we say that the financial economy is a leading indicator for the real economy. Now that we know the relationship between the two, the real economy and the financial economy, we now can take a look at where we are currently at in the cycle. So I'll first take a look at where I believe that we are currently at in the economic cycle, and then reverse engineer into where we currently are at in the market cycle. So the reason why I start off with the economic cycle and then working my way backwards to the market cycle is because I believe that to understand where we are currently at in the economic cycle, it's not as complex as understanding where we are currently at in the market cycle. But this doesn't affect our analysis, right? Because we know the relationship between the economic cycle and the market cycle. And the economic cycle usually lags between 3 to 6 months behind the market cycle. So if we can know where we are in the economic cycle, we can just reverse engineer our way back into where we are currently at in the market cycle. So with that, let's take a look at where I believe we are currently at the economic cycle. Right, so if you have been following the news and you have not been living in a cave in the past couple of months, you have known that the US economy is in a recession right now. So if the US economy is in a recession right now, we are at the downward sloping part of the curve. So either this part of the curve here or this part of the curve here, right? So that's the first thing to take note. We know that we are at the downward sloping part of the curve. The next question that we have is which part of the downward sloping part of the curve we are currently in. Right, so if you take a look at the chart, there is this first part here and this second part here. So are we at the top part of the curve here or are we at the bottom part of the curve here? Doing my own research and analysis of economic figures and data, I believe that we are at the lower part of the curve. In fact, recently, the chairman of the Fed or the chairman of the US Central Bank, Jerome Powell, came out and mentioned that he believes that the economy will start to recover in the months between July and September. So it's a couple of months from now. On top of my own research and analysis of economic figures, the chairman of the Fed, Jerome Powell, has also mentioned that he believed that the economy will start to recover between the months of July and September. So it's just a couple of months from now. And that is why I believe that we are at the lower part of the economic cycle, right? So we haven't reached the bottom of the economic cycle yet. I believe that we will reach the bottom of the economic cycle in a couple of months from now, right? So we are somewhere along this part of the curve, not the bottom, but between the points here and here, right? So we are just at this lower part of the curve. So that is where I believe we are at in the economic cycle. And now that we know that we are at the lower part of the economic cycle, we can then take a look at where we are currently at in the market cycle. So if we take a look at the corresponding points of the market cycle, we will know that we are between the points here and here. So we are at this part of the market cycle. And this part of the market cycle corresponds with an increase in prices. But a point to take note is this, right? Even though prices are generally rising over time at this part of the cycle, prices do not rise up in a straight line. So instead, prices tend to follow this cycle here, right? So it will follow a wave-like motion here. It will just follow a wave-like motion. So it won't rise in a straight line. But overall, prices are likely to increase over time. So that is where I believe we are currently at in the market cycle. And this chart illustrates why the stock market is still going up even while the economy is doing worse. So hopefully you have learned something from this video and have liked this video. And if you did, smash that like button because it will help the channel grow. And if you want to watch more videos such as this on investing, trading, and the stock market, make sure you subscribe to my channel because each week I release one new video about investing, trading, and the stock market. So I'll see you in those videos to your financial success.